Hi, welcome to the channel, and this is Growing Well. Trouble is brewing for my wheel strategy portfolio, which I have sold cash secured puts for a position size of almost 25 grand. If you're unsure of what a wheel strategy is, it is a simple yet attractive option strategy that you can execute on your investment portfolio to tremendously boost its returns. Learn more about the entire strategy over here in this video, links in the description below. Previously, I've also shared that banks are attractive targets to execute the wheel strategy on. In fact, I was rather aggressive when executing the wheel strategy on the banks themselves, and I have several positions which you can see over here, and most of them are underwater, leading to some temporary loss on the portfolio. So it is during the bad times like this that it takes more effort to navigate your way through these positions and turn a losing trade back into a positive one. And therefore, the purpose of this video is to show you the alternatives that you can take to repair your trades, so that the next time you find yourself in a similar position like what I am in today, you will know what to do better. If you like what you see here, please show your support by smashing the like button and subscribing to the channel if you are new. Alright, so these are all my options positions and they are all part of the wheel strategy. I've already sorted them by expiry, so the top few lines are the ones that are going to expire soon. In fact, at the end of this week. Alright, so a quick browse through the list of positions that I have. The ones that are causing trouble are mainly the banks. I have a BAC put at a strike of 24.5 expiring this Friday, and currently Bank of America is trading at 23.895, so about 23.9. And depending on how the price of BAC moves, this option might or might not expire worthless. But no matter what, if it does not expire worthless, my plan for it is to roll it further out. So maybe I will be targeting the 23rd October expiry, or maybe further out, the 30th October expiry. And in fact, just earlier this week, I've applied another cash secured put positions on the Bank of America again, this time at 24 strike, and once again it is underwater. I've sold this put for 90 cents premium, and currently right now it is trading at $1.15. So we'll see how this turns out as the month progresses. So next, I have another covered call for the Bank of America at 25.5 strike. So without a doubt, I guess this option is going to expire at the end of the week. And this covered call option is sold against my stock holding position in the Bank of America itself. Over here, I have 100 shares of BAC. Although the trade price states that I've entered at 25.66, I've actually entered this position at a price of 24.545. The reason why it's showing 25.66 is because I've entered the Bank of America for another strategy, which is known as the dividend capture strategy. And the platform uses a first in, first out accounting method. Therefore, my entry price at 24.545 was sold away first, leaving the position with a higher trade price. But for my own personal recording sake, I will still regard my entry price for Bank of America to be at 24.545. Right, so if we go over to the charts, Bank of America it is currently showing this very ugly and terrible breakdown red candle over here. Previously, prices was forming a support at around like $25 until the start of this week, where prices just suddenly broke down below all the moving averages. So since the covered call is going to expire soon, what I can do is to sell another covered call on my 100 shares of Bank of America. And for this, we could look at a strike price of maybe about 24.5, which will be somewhere around here within the recent candles themselves, or we can also sell another one at 25, which will be above these moving averages, which is likely to act as resistances from here on. Alright, so let's go over to the option chain and consider our alternatives. Usually the plan will be to sell an option that is 30 days to expiry, and in this case there will be the 23rd of October. And for the 23rd of October, the 25 strike is selling at 60 cents to 63 cents. If we do a quick calculation at 63 cents divided by the strike price, the premium of the call option is still at 2.5%, still above the 2% that we are looking out for. So in this sense, there's nothing wrong with selling the 25 strike call, and the premium yield is still attractive at above 2%. But however, what I'm thinking is that this sell-off is going to be temporary and prices should recover back up soon. So if I sell the 25 strike 1 month out on the 23rd of October, it is likely that the call is going to get into the money, and then I'll have to roll out and up for a lesser premium. So in that case, what we can do is to consider a shorter term expiry. The next alternative we have is to consider the weekly option that expires in about 7 days or so. And in this case, it will be the 2nd October expiring in 10 days. So if we look at the option chain over here for the 25 strike, it is going at 19 cents to about 20 cents. So the criteria that we are looking out for is still the same. We want the yield to be 2% a month minimum. So since we are selling options that expires in a week, what we are targeting for will be just 2% divided by 4 weeks, since a month has 4 weeks. And therefore, if the weekly options can yield us 0.5% in terms of premium, that is attractive as well. And in fact, if I sell this 2nd October 25 strike call at 20 cents, and I sell them consistently for the next 4 weeks, this will yield 80 cents in premium. And if we compare to the 23rd October expiry, it is only going for 63 cents. So by selling the weekly call 4 times in a row, I'll get 20 cents of premium extra. Multiplied by 100 shares, there's $20 extra in terms of premium. Of course, this assumes that the stock price is going to stay consistent throughout this period and do not continue to sell off further. Otherwise, I'll not be able to continue selling the 25 strike call with the same premium yield. Alright, so that's going to be my plan for the covered call side on Bank of America. So I'm just going to sell one at 20, and then I'm going to click on confirm and send. And now just wait for this position to be filled. The cash secured put side has already been discussed, and the covered call side of Bank of America is done. Next, we have JPM. For JPM, I've sold a cash secured put at 97 strike. Currently, JPM is going for $93.80 in the market right now. So likewise, this put position currently at a huge loss. I sold this put for a premium of $1.42. Currently market it is going for $3.52 for a total loss of $210 in the position. Basically, my reason for getting into JP Morgan cash secured put is because of this. It has dividends coming up, and I'm thinking of capturing the dividends for my investment portfolio. In order to capture the dividend, I'll have to own some shares before the ex-dividend date. And one way to do that will be through a cash secured put. While waiting to own the shares, I'll get to collect some premium as well. So that was my thinking. And when I see JPM being supported by the 100 SMA and also a horizontal support at $97, it seems like an attractive deal to me. So which is why I sold this put last week. And who knows, this week only to wake up to a horrible nightmare in which it has gapped down and currently at only $93. So there are a few options I can do about this. Dividends is coming on the 5th of October. What I need to do is just to own 100 shares before 5th of October. And if you look at our option chain, there is another week of options that is available for us to trade, and that is on the 2nd of October, expiring in 10 days. Alright, and as we are speaking, the Bank of America covered calls has been filled. Back to our JP Morgan, there are a few ways we can go about doing this. This is my position over here, the 97 strike put, as indicated by this symbol over here. So firstly, what we can do is to sell the 97 strike call that is expiring on the 2nd of October. And this will give us 93 cents to 96 cents. And then we'll let our cash secured put get assigned. And if Bank of America reach $97 by the end of next Friday, then I'll just let it go and collect premium on both sides of this covered call that I've sold, and also previously on the cash secured put that I've sold. Right? So I bought at 97 and I let go at 97 with no loss at all, and all the premium I'll get to profit. And if that happens, I'll just have to immediately buy back another 100 shares at the market price for my dividend capture strategy. Now another alternative would be to roll this 97 put out into the 2nd October expiry to collect more premium. Now let's look at our premium yield if we do that. In order to do that, we have to buy back our 97 strike put, and then we have to sell the 97 strike put that is expiring on the 2nd of October. So if we do that, we'll get a credit of 57 cents for the trade. So comparing this rolling alternative to the previous one, which is to sell a covered call on our stock position instead, it looks like selling the covered call is much more attractive, giving us more premium, in fact about 37 cents more. Right, so basically for this position, this is what I'm going to do. I'm going to sell a covered call at 97 strike, and I'm going to let this 97 strike cash secured put be assigned to me. So I'll be executing it on this Friday, And I don't think by this Friday prices would be able to go back up to $97, right? And no matter what, the plan would be to hold on to 100 shares for this position and then hold it throughout the dividend period. And at the same time, continue to sell covered call at my purchase strike to earn premium while waiting to get rid of the stocks. So those are basically the problematic positions that I have in the portfolio. For EEM, this is a covered call positions against my stock holding, which you can see I have 200 shares at a trade price of $41.70. So for this, there's no problem, it's going to expire worthless. And next, FXI is also another covered call position, and that's going to expire worthless as well. So these two positions are bringing in good profits for the account. And then followed by that, you can see I have a series of other Bank of America cash secured puts that's expiring every other week out. And these have a rather high strike price of 25.50 to about 25. So we'll see how these positions turns out as the month progresses. And likely what I'm going to do is to absorb some positions and let them get assigned to me, while the rest I'm going to continue rolling them down, rolling them out, and collect some more profits as I go along. Alright, and next we have Yum China. Yum China, this is also another cash secured put position, which I've sold earlier back for a premium of 150 and currently is going for 130. And if you look at the stock chart, this is currently how it is looking like right now. $50 is over here and it seems like a rather strong support. It has been resisted by the prices a few times and also have supported the prices a few times, including this time round. So whether my cash secured put on the Yum China holdings will get into the money and whether I will get assigned, we will have to wait and see. Okay, and followed by that, we have yet another Bank of America, this time 24 put, which I've said I've sold earlier this week. I have another FXI cash secured put with a strike of 41.5. So the aim of selling this put is to get the 50 shares to round up my current stock holdings to 200. And when that happens, I'll be able to sell another contract of the covered calls on the position, generating more premium for my investment portfolio. Okay, it's already Friday of the week and prices have moved quite a bit since the last time we have looked at it. There will be a slight change of plans to what I've said previously. Let's take a look at our first option that requires our action, and that is the Bank of America 24 strike put. Right, this is currently in the money. Currently, Bank of America is trading at 23.36. So we will definitely have to roll this, otherwise we will let it get assigned and then buy up the 100 shares at 24.5. And since I have so many Bank of America puts, there's likely going to be a sign if prices don't move up in the short term. What I'm going to do is I'm going to roll this out. Right, so let's take a look at our options. So this is the one that I'm owning, 24.5 put. Currently is going for about 112 to 115 each. Okay, so I'm going to click on buy to buy it back. Next, let's look at the option that expires 1 month out from here. That will be the 23rd of October. So 23rd of October, if we look at the 24.5 strike, it is currently going for 167 to 170. So if we sell the 24.5 strike, we can get quite a lot of premium. The premium for the trade will be going for 55 cents, and that will be $55 when you translate it to 100 shares. Either I can roll it out to the same strike price. Another alternative will be roll it out and down. So I can also sell the 24 strike instead. So if I change this to a custom, I want to sell the 24 strike. By selling the 24 strike, our premium has changed from about 55 cents to now 22 cents because the 24 strike puts, they are going for much lesser premium. So it is up to your personal preference and your trading style which one you want to go for. You can go for the 24.5 if you believe that Bank of America is going to rise up to 24.5 in the long run, and then your sold put will expire worthless when that day comes, right? Or you can also sell the 24 strike at a lower price and then hope that the Bank of America rise up to 24 as soon as possible, and then you get rid of your sold put as soon as possible. So that's what I'm going to do, rolling out and down into the 24 strike and then just collecting 22 cents in premium. I'm not going to be greedy over here, and I want my puts to expire as easily as possible. So that's what I'm going to do, and then I'm just going to click on confirm and send, execute the trade at market price. Alright, so immediately the trade has been filled. Next, the trade that we have to manage will be this JPM. It was entered at $1.42. It is currently going for $4, so very deep in the money because JPM is currently trading at only $92, close to 93. So let's look at our options for JPM. This is the option that I'm holding. I'm going to roll it out into the next week's expiration, which is in 7 days. Previously, we have said there are two alternatives. One of them is to roll it out into another put. Another one is to let this get assigned, get 100 shares, and then sell the calls for JPM. Alright, so let's look at our first one, which is to roll it down and see how much premium we can get. So what I want is to buy back and then I want to sell another one at 97 strike. For this, market price is currently at 410. If we look at the next week's expiration, the 96.5 strike, it is going at 390 to 405. So definitely it is going to be lesser than $4.10. And if we roll it down, we will have to fork out some money and this will be a debit roll. As much as possible, we want to avoid rolling for a debit. And we always want to roll for break even, if not to get some credit. Therefore, our only option is to consider the 97 strike put. So if I roll the options out into one more weeks of expiry, I'm going to get 35 cents in premium. Now what if I sell the call instead? If I sell the call, it is going for 39 to 42 cents. So this time round, difference in premium is not really that large anymore. What is the downside of selling the call? Is that I have to own the 100 shares. And owning 100 shares will take up a lot of my capital. By rolling the put into another one that expires a week out, what I can do is to delay the outflow of my capital. So I'll be going with this and delay the owning of shares. Anyways, the ex-dividend date is only on the 5th of October, so there's still time for me to acquire the shares if I need to. Currently market at 37 cents, I'm just going to click on confirm and send. And immediately it is executed. So that's all for the options that are going to expire today, and that's all that requires our attention. Alright, I hope this has been a useful session for you guys with regards to how you can make use of the wheel strategy to generate additional income for investment portfolio, alternatives to keep your portfolio safe, and also repair the positions should you get too heavy on them and get into a little trouble like what my portfolio is about to face right now. As always, remember to smash the like button and subscribe to the channel. You are also welcome to join our Growing Wealth Telegram community chat for further sharing and discussing of trade and investment ideas. Thank you so much for watching. I'll see you in the next video.